If you're consistently profitable and don't know why, I'm going to show you exactly why. I'm going to take you through the journey every trader goes through and show you the transformation required to become consistently profitable. So let's start with the trader's journey. Most traders that start their journey either have a little bit of success or they end up losing. Now let's move up here to the section of unprofitable and semi-profitable trader reality. A lot of the traders here have the same problems and they come in different orders. Maybe someone will experience one before the other, but eventually you'll experience all of them before you turn profitable. So common pitfalls and mistakes for traders. The first one I want to talk about is a big one, and that's the lack of strategy or discipline. When you first get started with trading or investing, you really don't have a strategy because unless you've had a mentor or you've gone through a course, you don't know what you're doing. You're simply following the vibes and checking out crypto Twitter and going off of what influencers are buying and mainly just buying what they buy. Now, without a rigid strategy, you're essentially drifting in a fast-paced market. You'll find yourself jumping into plays because they look good in the moment, but because there is no governing logic, you can't replicate your wins and diagnose your losses. This is mainly why you're inconsistently profitable, is because you have no underlying framework to continue to follow. You aren't building a business here. You're simply running a series of disconnected gambles that eventually revert to mean, which is zero. So essentially, you might have a series of winning trade, a lucky streak where the market conditions are good and you win, but it's okay. Everyone wins during good market conditions. But what happens during bad market conditions? That's usually when people will find trouble, is that they try to continue the same thing they did in a good market and they can't seem to find results. But that's what the market does. The market will continue shift between good times and bad times, and you have to learn to adapt to maintain your cash position so you can survive long enough for the good times to return. Now, the next issue here is averaging down losses. And this is what happens when people get married to a coin. So this is the ultimate capital hemorrhage. By adding capital to a losing position, you are marrying a broken thesis. In on-chain markets, many projects never recover. So you might see a coin gain attention for a little bit and there's a lot of hype behind it. So you decide, this is the one. I'm going to go all in this one because it's going to make me a lot of money. And what tends to happen is the markets shift. And that was a short-term move in the markets that can't be sustained, especially if things move up extremely fast. You simply won't see the market sustain that price and it'll revert back to the price where it took off from, or even worse, go down to zero. This happens extremely often on chain, and you have to learn to be able to spot the difference between a project that can sustain that price for some period of time and the project that is simply moving off of hype. Moving off of hype is extremely common in crypto, so you shouldn't get caught buying the top because eventually things will come down in an elevator style fashion. Now, averaging down doesn't simply mean lowering your entry. It increases your exposure to a failing asset and more importantly, locks your capital away for the next narrative that is catching fire. So this is opportunity cost and the worst thing you can do because your capital is a limited resource and you can't go burning it on plays you have full conviction in because you think it's going to move towards the upside eventually. Sometimes that never happens and that capital is gone and now you won't be able to play the game anymore because once you're out of capital, you're pretty much done with the game. You can no longer play it. So capital preservation is extremely important if you want to be successful in the investing game. Now, another problem you might also face is having too many positions open. And this is a big problem because the market is very correlated. So every new position dilutes your focus and your capital. Because narratives move so fast, your execution weakens if you don't have a plan for all of them. And it's very hard to keep track of 5, 6, 7, 8, 9 coins if you have them all at the same time. The only time this is okay to do is if you're managing positions and adding onto new ones as you've cut other positions. So we'll get into that later. But for the most part, having too many positions open is a bad idea because you will get lost in trying to manage them all. And eventually, when the market turns, it will manage them for you by going down, which isn't great. That's not what you want. When the market turns, they all get hit and your overall portfolio will get smashed. When it comes to on-chain or individual coins, you don't know if the narrative you're in will ever revive again. The on-chain game is brutal, especially in a bear market. If you happen to invest in on-chain in a bear market and the bear market lasts longer than you expected, the attention will simply shift to a new coin that's closer to the start of the bull market and your coin will be forgotten. Better tech will come along and attention will be focused on that coin that has less holders underwater looking to sell their coins at break even or a slight profit. So it's really important to pay attention to where we are in the market environment. Have we been running hot for the past few weeks and things have been looking so good? Then it might be time to pay attention to a possible downturn coming. And in that case, you might want to take profit on your portfolio as to avoid the downturn and have cash on the side to take advantage of the opportunities that have yet to come. The next one is no journal or performance tracking. So if you don't track your data, you are doomed to repeat the same psychological errors forever. A lack of journaling means you have zero postmortem for your trades. You won't notice that you consistently lose money on animal memes, but win on AI infrastructure. Without tracking, you are blind to your own edge, making scaling capital much harder. So you might be better at trading in one arena in crypto than the other. You might be better at memes. You might be better at AI. Maybe you have an edge in DeFi, but you won't know that if you don't have a record to look back on and see, okay, I've won in this environment, or I've won investing in this narrative, or I'm early to certain coins, to know where you stand out. And I get it. Sometimes this isn't sexy stuff, but this is what it takes to win. And actually, when you start winning huge amounts of money and start scaling your portfolio, that's where the fun begins, because you start to see the process is repeatable and you're continuously winning in an environment that is extremely hard. Now, the next one is no trading plan. Entering a trade without a plan is like entering a taxi without a destination. The meter adds up real quick. When the market moves against you or even for you, you'll freeze or panic. This leads to round-tripping gains where you watch a 5 million market cap coin go to 50 and then back to 2, all because you never defined your if-then scenario before the volatility hit. So the reason why a plan is extremely important is because when price hits a certain level, whether it's up or down, you will freeze in that moment because you are under a high pressure situation, not knowing what decision to take or which one is the right one. That's why having a plan is so important. Before you enter the trade, let's say you get into a coin that's around 2 million market cap or 5 million market cap. You have to decide before price actually starts moving where you will be scaling out and taking profit and where you'll be exiting the trade if it doesn't work. You have to have those in mind because when the market starts moving, it'll just be so much harder to make that decision. So you need to have these areas locked in before the market gets going. And a lot of success when it comes to investing is done through pre-planning. You don't do it through a vibe or because you felt like it. You have to have a plan. And you learn this over time. And if you haven't already, you will see over time, once you begin to incorporate that plan, your results will speak for themselves. The next one is ignoring risk to reward ratios. This is a mathematical death sentence. If you take trades where you risk $1 to make $1, you have to be right nearly 70% of the time. When you play the on-chain game, the goal is asymmetry. Why would you take on so much risk to only get back what you put in? It doesn't make any sense. You might as well go to the stock market because this is not the game you want to play in crypto. You're looking for 5x's to 10x's to 20x's in crypto. So when you're looking to risk $1, you should be at least making $3 or more ideally. Ignoring these ratios means one bad rug or narrative collapse wipes out 5 of your winners, ensuring that even if you are good at picking coins, your bankroll never actually grows. So you might be good at picking coins, but your risk to reward ratios are just terrible. You might enter at $1 million, your hold time is 2 seconds, and as soon as it pumps 10%, you exit. This is not the way to play the on-chain game. The way I like to play this game is I like to enter at 1 million and start scaling out at 3 million, a portion of what I entered, maybe my initials, because I want to be risk-free. The rest, I let it ride until it goes up multiple X's, and then I decide to pull it out once I'm above a 3X. Whether I hold for more than a 3X or less than a 3X depends on the narrative and the coin I'm trading. So it's discretionary, but I have a reference point of what to do depending on what coin it is. Because I've been trading for so long, I have a lot of reference experience to pull from, and it's become a second nature habit. I like to go compare my trades versus past trades because the past trades gave me a playbook. They give me a roadmap of how to play the trade before the trade even moves. I have an idea if a coin can hit a 10x or a 5x. I have an idea of if it's better to scale out at a 3x or a 5x. And this all comes with experience. Now, the important thing to point out is you can have good experience or bad experience. Obviously, you don't want to pull from bad experience because it creates bad habits for you. So you need to have the right habits down to have the good preference experience. Now, this is a big one. I know a lot of people suffer from this. I suffered from this at the beginning. I had a lot of FOMO, a lot of fear of missing out. So FOMO is the process of becoming exit liquidity. When you buy because the price is vertical and the hype is at peak, everyone on your timeline's talking about it, you are buying from the influencers who entered at 2 million market cap. The consensus is almost always a top tick entry, followed by a violent correction, leaving you holding a bag while the smart money has already rotated into the next play. So I had a problem with this. I would enter too early and I would get a worse entry. The market would go down, shake me out. I would exit and the market would pump afterwards. This is what I had during my early days. Obviously, I fixed that now. However, this is something that a lot of people face trouble with. And the cure to this is to know that the market is filled with opportunities. If you miss one now, there's always going to be one tomorrow. There's a reason you and I are still trading to this day is because the market never stops giving you that chance to make some money. So why would you FOMO thinking you're going to miss it? You're never going to miss it. There's always another opportunity in the market. It is abundant so long as humans exist. There will always be another opportunity that exists in the market. Now, here's what I was talking about. Success with bad habits. Profits made with bad habits are borrowed capital. If you made money FOMOing or hoping, you have reinforced a behavior that will eventually destroy you. When the market regime shifts from easy to hard, your bad habits will double down. This is what it looks like. Because your foundation is built on vibes rather than structure and rules, you won't know how to handle the first real drawdown. You'll try to revenge trade your way back to the peak, but without a structural filter, you'll feed your remaining capital back to the market. Because you're trading off of vibes, what worked before will no longer work. Because the market structure, the underlying movement has shifted, and your failure to recognize it will cost you money. Like I said, in a bullish market, it's extremely easy to make money because all you have to do is buy the dip. When there's liquidity available, when there's attention available, and you've got your eyes in the right place, all you have to do is buy the right coin, and eventually it will pump. In a more challenging market where liquidity is thin, there isn't much interest, it gets a lot harder. And that's where the trouble starts because you are playing the same game in a different environment, and that simply won't work. So you have to adjust. You have to identify what's going on and adjust your gameplay. Now in the easy market, you aren't a winning trader. The market was simply easy. During the euphoria phase, like the massive Solana meme run, the tide lifts all boats. Every coin goes up, every dip is bought, and every mistake is hidden by sheer momentum. In this environment, retail traders mistake market movement conditions for skill, and that's not the case. What it looks like, you start thinking you have a magic touch. You think you're a genius like everybody does in a bull market. But because you haven't built a repeatable process, you're just a passenger on a move you don't understand. When the easy liquidity disappears, you'll find that your strategy was just being at the right place and the right time. And this hits home for me because this was my experience until I built a framework that is repeatable no matter what the market conditions are. And what I mean by that is my framework tells me when conditions get harder, I have to change my approach. And that's built into the framework. So when conditions change, I have an idea when they change, which allows me to step back and change my strategy. Some of my strategies simply don't work in a bear market, so I can't really do much. But that in itself is a position. Staying in cash is its own position. So you have to take that into account as well. Just wanting to trade and trading constantly just for the sake of trading is a strategy in itself, but doesn't mean it's a good one. Now, if you identify yourself in any of these, it's fine. You can fix these things, but you have to take an active approach to doing so. You have to be aware of what you're doing it and why, because these decisions come from somewhere, which means you might have an itch to do something because you are bored. And trading or investing is a very high dopamine activity because you get constant stimulus from the market, either telling you you're winning, losing, you're right or wrong. So the best thing for you to do is identify which camp you fall in on. Obviously, you could be more than one of them, and then try on the next trade to take things a bit slower and implement a different way of operating. Now, let's move from the operational side of trading to the emotional side of trading. And we operate from one of these usually when we're inconsistently profitable. First one being fear. Fear causes you to abandon your logic at the exact moment it's most needed. It manifests as panic selling the bottom on a healthy correction or paper handing a winning position because you're terrified the gains will vanish. I've been on this one, and it cost me a lot of money. When I was starting out, this exact issue happened to me. I would buy in at a really good price, the market would move up and then retrace, and I would get shaken out during the retrace only to see the coin go up 10, 20, 30x above the price I sold at. The market will pull this lever by creating stop hunts or fake outs. It creates violent downtrend wicks designed to trigger your survival instincts. The market wants you to sell your spot bags to the whales who are waiting to buy the blood on the streets. So fear, obviously, is something you have to work on, and it's actually triggered also by poor mismanagement of your funds. So if you're over invested, you will feel more fear than you would if you were allocated more reasonably. Next one is greed. Greed blinds you to the risk-reward ratios and exit signals. It turns a 5x into a hope for 100, causing you to hold through the top and back into the red. It also leads to over-allocating into a single hype narrative without proper diversification. The market lever. The market pulls this lever by creating parabolic green candles by making price look like it'll never start going up. The market forces you to ignore your exit protocol until the liquidity is sucked out and the price crashes. I can't tell you the amount of money I have saved by avoiding these plays. If there's anything I was naturally good at here was avoiding coins that go straight up because I never trusted the moves. And there was no way for me to define proper risk when a candle goes straight up. You'll see this on Twitter as well. You'll see people saying, as soon as I buy it, the coin will go down because they have that experience of top blasting coins and then the coin stops going. So you have to keep in mind, for the most part, top blasting a coin, not a strategy. It just simply doesn't work. There are exceptions in which you could say, oh, it worked here, it worked there, of course, but it is the exception, not the rule. If you want consistent profits, you have to follow the rule and not the exception. And revenge trading, probably the worst thing that can happen to you after a string of losses. This is the quickest way to zero. After a loss, the ego takes over and tries to win it back by taking high risk, impulsive trades. You stop trading the chart and start trading your profit and loss. This leads to a spiral of bad decisions where each trade is more desperate than the last. the market lever, the eventual lever the market pulls after you break enough rules to the point where you're desperate and emotional enough to throw the rules out the window and try anything. And this is what happens after the market punishes you again and again. Eventually, you have nothing to lose, so you risk to lose it all. So it's a pretty slippery slope when you get involved in the markets and you're simply trading off of vibes or no framework at all. The market has no rules. Therefore, you have to create rules from yourself to protect you from yourself. Otherwise, you're going to become a victim of your worst impulses and habits. A lot of people think from the outside looking in, especially with the way Instagram makes it look like, trading is a sexy lifestyle, and it can be, for sure. But behind the scenes, there's a lot of planning and rule following involved. Otherwise, you will literally destroy yourself. So over here, the typical outcomes, right? And this is probably why you're watching this video. You have inconsistent results. This is a byproduct of a lack of strategy. Because your wins come from feeling and your losses come from being lucky, you have no baseline. You have a winning week where you hit a 3x on chain followed by 3 weeks of slow bleeding. You can't project your income or scale your size because you don't know if your P&L is a result of your skill or just temporary market tailwind. You have large drawdowns. This is the direct result of averaging down or ignoring risk to reward. The outcome, you experience the elevator down while your gains are built step by step. Your losses happen in vertical drops. One unhedged, unplanned position in a failing narrative wipes out months of disciplined growth, forcing you to start from zero, psychologically and financially. Emotional exhaustion. Eventually, the market will take its toll on you. This is the tax paid for emotional trading, fear, greed, and revenge. The outcome, because every price tick is a personal attack on your ego, you stay in a state of high cortisol. You're checking deck screener at 3 a.m., neglecting your mental health and personal life. Eventually, the mental capital is spent. You begin making even worse decisions simply because you are too tired to think structurally and logically. This is a terrible place to be in, and it's a negative feedback loop that makes things even worse and worse. And this is where you have to take a step back from trading and investing and just focus on resetting. With the emotional exhaustion, you also have a loss of confidence. This stems from no journaling and inconsistent results. The outcome, after enough failed plays, you begin to doubt the math itself. You hesitate on perfect entries and overstay the bad exits. You stop trusting your eye for narratives, which leads you to the most dangerous state of an investor. Action paralysis. You no longer trust yourself. You tell yourself you have no edge in the markets and you've lost your skill. And this is all a symptom of not having a plan and not having a framework and not having something you've tested and can trust. You're simply going off vibes. So you can see this is the common theme for most of these issues stem from not having a plan, not having a framework. And a lot of people don't know where to get that framework from because they're simply following what the herd is doing and what it looks like on social media. The problem is social media is mostly fake. There's nothing there. People can say whatever they want with no proof required and act however they want with no real consequences, which is why it's important to discern who you should be following versus who you should ignore. Now, the final typical outcome here is account stagnation or decline. This is a structural conclusion of too many positions or poor exit logic. The outcome, even in a bull market, your net worth stays flat. You're chopped out by rotating the narrative 24 hours too late. While the market is moving 100%, your account is moving 5%. You are doing all the work of an investor with none of the rewards. This is a terrible place to be in because you feel like you're wasting the precious bull market time that the market has gifted you with, yet you can't seem to grow in an easy market. Why? And this may happen because you simply don't know that the market is rotating and soon eventually your turn will come if the structure is correct. However, you don't know that because you don't have the market experience or you don't know what moves markets and you don't know what to trust. How can you remain patient and stable enough to wait for your turn? I remember I was in a similar position in 2021 where I was invested in 2 coins and everything had pumped and we had reached towards the end of the bull market. I stayed patient and at the end, the market caught up with what I was expecting it to do and the coin moved from $7 million market cap to $500 million within a short span of 2 to 3 months. I had seen it work time and time again, and I simply had to trust the process. But trusting the process is difficult when you don't have anyone showing you the way and proof that it has happened in the past. And that's what I do in my consulting program. I show you past evidence that I know this setup works in the right conditions again and again and again. I've been involved in the market for 9 years, so I have all these plays saved in my head because I've been a participant of them. I've seen what they've done, I've expected it, and I've lived the outcome. So if you guys are interested in shortcutting the time it takes for you to create or learn a framework, make sure to check the description below. I'm running at a 50% discount for the first 2 students interested in signing up. All right, so after all this pain and suffering, probably over the course of years, because that's usually what happens, people typically quit after 2 to 3 years of not seeing any success. Eventually, after enough pain comes the need for change. Now, the need for change usually comes about after you begin to recognize your repeated mistakes. Instead of looking at the chart and seeing bad luck, the investor looks at their history and sees a loop. They realize that the market isn't changing, they're simply hitting the same tripwires, FOMO, revenge trading, no exit, over and over again. The shift is you move from blaming the whales or manipulation to acknowledging that your current system is perfectly designed to produce losing results you're getting. So it's not so much that the market is at fault, rather it's how you operate in the market, which is a huge shift, because then you take all the blame, which means you take all the responsibility, and you can change that. You can't change how the market is reacting. That's something you can't control. And there's no point in trying to change something you can't control. Your focus should shift on yourself. Now, to be even able to reach the point to need change, you would need to be aware of the habits that drive results. This is the move towards more structural reasoning. You realize that your profit and loss is not a reflection of your intelligence, but a reflection of your trading habits. If your habit is top blasting because you feel FOMO, your result is being exit liquidity. It's a simple equation, and one that the market manufactures to take advantage of people who don't have a framework. It takes advantage of emotion-driven decisions. So the shift is you stop chasing the next Bitcoin and start building a framework that you know works over time. You accept that a 10x move is the output of a disciplined 10x input, meaning the moves that precede a 10x move is being patient, is knowing what to look for before price begins to move. Without those things, you won't be able to catch the coins that have the 10x moves. Now, to be able to achieve all this, you would need to have the decision to improve, the commitment to improve. This is the transition from participant to professional. It is the conscious decision to stop trading on hope and start trading on structure. It requires humility to admit that your gut feel is a liability, and the discipline to install a framework overrides that. The shift looks like you decide the cost of staying the same, the emotional exhaustion, the account stagnation is now higher than the cost of change. You are no longer looking for a dopamine fix, you are looking for a systematic overhaul. So at some point, you get tired of losing the game. There's only so much loss one person can take. When you reach that point, you decide, okay, something needs to change. Either I stop playing the game or I learn to get better at it. Now, when I started investing in trading, it only took me a couple of months to find a mentor because I knew that I knew nothing about this. And without someone to teach me the ropes, it's going to take me a lot longer to get to where I need to be. And I did have a mentor. He showed me the ropes. He taught me a lot about risk management and what not to chase, which saved me a lot from all these coins pumping 10x here, 10x there, and having to chase them required to catch those 10x pumps. But he had been in the market for years. Taking his course didn't solve all my problems, but they solved a lot of problems, and they definitely shortened the time it would have taken me to learn risk management. And because of it, I was able to survive in the game long enough to become profitable and quit my job and go full-time into crypto and travel the world and do everything I wanted. So you need to make that decision to change your framework, whether it's doing it on your own or finding a mentor. I would suggest finding a mentor, especially if you want to cut that time by a significant amount. You would require help from the outside because otherwise you're going to be figuring out every common pitfall, every mistake, and that takes time and it takes a toll on your emotional health. So that is the need for change. Let's move on to the transformation path, right? So what does that look like? A mindset shift is required from prediction to probabilities. The amateur tries to predict the future. They want to know exactly where price will be tomorrow. The professional knows the future is unknowable, so they trade probabilities. What it looks like. Instead of saying this coin will hit 100 million, you say based on past data and patterns, the current market conditions, there's a high chance of a 3x move from this structural base. You stop being a fortune teller and start being a casino. You play the edge. And over a large enough sample size, the math ensures you win. So you start realizing nobody knows what's going to happen in the markets. Actually, anything can happen in the markets. And most people are using past data and probabilities of what has happened in the past to predict the future. Of course, you're not predicting the future. You're assuming this has a higher likely chance than X happening than Y does. So there's no prediction happening. It's all probabilities, right? Which is why anything can happen. From quick money to consistent execution. Quick money forces you into a position of high risk and low logic execution. Consistent execution is a realization that wealth is a byproduct of a repeatable process. The execution. You stop hunting for the one-hit wonder that fixes your life. Instead, you focus on the boring clinical execution of your ingestion, filtration, and exit strategy. You value a clean trade where you follow the rules more than a lucky trade where you made money by accident. Everyone is trying to replicate the next Pepe, the next Shiba, the next Doge, and we just know these come once every 4 to 5 years, and you don't even know which ones they're going to be. Not only that, but you also have multiple chains to pick from, and then you have coins vamping each other for attention. It's a losing game. You're simply buying a lottery ticket and trying to win. It doesn't work. Instead, you need to shift to a more long-term approach and growing your wealth over time with a repeatable process. This is a slower way of doing it, but it has a much higher chance of success. You have to move from impulsiveness to patience. The shift is Impulsiveness is the retail default operating system. The need to be in every move, the need to be in every trade. Patience is the architect's shield. The ability to wait for the exact structural alignment before deploying capital. This means you know the setup you're looking for, and you're sitting tight until you can find that setup. If that setup doesn't show itself, you have no reason to be in a trade because you don't know the odds of success. So you're sitting there blind, waiting for something to happen that you don't know has a high chance of happening. Whereas in my framework, I have setups that I know work time and time again. Why? Because I've seen them work time and time again. And when I go look at past data, they work time and time again. They have certain requirements, but I know those requirements and I know what to look for. What it looks like is you stop chasing green candles. You understand that in the on-chain niche, a new sub-1.5 million opportunity is born literally every week. You develop the sitting skill, which is important. That is a position. You wait for the whale cluster to form. That has to do with wallet tracking. Wait for the narrative to find its base and wait for your exit signals to fire. You trade less, but you realize more. So in my framework, there are different signals I look out for. Attention, narrative, and a couple of more. You guys can check out the free PDF down in the link below if you guys want to download that. But it helps me categorize and make decisions more efficiently than I would without it. Now, the final requirement for transformation is from external blame to personal responsibility. Amateurs blame the feds, the whales, the rug pullers for their losses. Professionals realize that while the market is manipulated, they are the ones who click the button. No one forces you to click the button. You know rugs exist. You know manipulation exists. However, the action to press the button is on you, and that's why all of this responsibility falls on you. You take 100% ownership of your profit and loss. If you got caught in a bottom selling situation, you take responsibility for your entry or risk management. By removing the blame, you gain the power to change. If it's your fault, you can fix the logic. If it's the market maker's fault, you are a victim forever. You have no control over what the market does, but you can control your own actions. Extremely important to shift that paradigm. So, to summarize, before you get the actions right, you need to mentally be in a place where you understand that the way you were operating was the reason for your downfall. The way you were operating was the equation for losses. However, if you change that to a winning operation, a winning framework, and I mean the way you proceed in the markets is the equation required to either see success or failure. Patience usually leads to success. That is a characteristic of success. Understanding structure, that is a characteristic of success. Understanding attention and what it does to a coin, that is a characteristic of success. Understanding how whales are positioned also increases your success. So you can see we have multiple cards in the deck, and we are taking the cards that stack the success rate in our favor. Whereas when you're going by gut feel, the market's actually designed to exploit your emotions. It knows what's going to trigger the FOMO. It knows what's going to trigger the fear. Have you ever been part of a coin where you see it dump and then only to reverse and you sold your position? That's the market doing its job. That's why a mindset shift is a prerequisite to becoming a successful investor or trader. Now, to do this efficiently and faster than you would otherwise, education and skill development is required. Learning market structure. Market structure is the skeleton of price action. On-chain, this means understanding what price is doing and why. It's the ability to look at a chart and identify if a coin is in accumulation, expansion, or distribution. The execution. You stop looking at candles and start looking at architecture. You learn to identify the floor and the ceiling of a saturated narrative, allowing you to position yourself where the physics of the market are in your favor. Being able to identify accumulation is key because that's where the 10x's are born from. When coins are in accumulation, usually they're at a safe risk to reward where you can actually take a bet and expect significant returns. Taking a trade during the expansion phase is risky, but if you can get in during the pullback, you can ride that expansion depending if you have a target of where that expansion is going to. And finally, the distribution. If you can identify distribution, you simply won't participate and wait for the coin to come back to your entry if you think it has higher to go. Understanding setups and context. A setup is just a pattern, but context is the catalyst. A MACD divergence on a random coin means nothing. A MACD divergence on a coin with heavy attention that just hit a major narrative support is a high probability trade. If you know a coin is being watched and there's heavy discussion around it, that's the attention required to make the MACD have significance, and that's the context required to understand the trade and the structure. So you have to learn to read the environment. Is the broader Solana ecosystem bullish, or is it time for Ethereum coins to run? Is the AI narrative cooling off? By placing your technical setup within the correct market context, you move from a 50-50 coin flip to a high conviction play. Now, just because you have a high conviction play doesn't mean you get to ignore risk management. So you have to study that. Risk management means protecting your portfolio. In the high volatility world of crypto on-chain, it's not about how much you can make, but how little you can lose when you're wrong. You move away from the all-in bets. You learn to size positions based on the distance of your invalidation point. You treat your capital with respect, and you only deploy it when the risk reward is asymmetric, minimum 1 to 3. In crypto, it's very normal to see 5, 10, 20 X's, but for the minimum part, you need to have at least 1 to 3 to make it worth it. This ensures that even a 40% win rate results in a growing account. And finally, backtesting strategies. Backtesting is the lab. It's where you prove your edge before risking a single dollar. By looking at historical on-chain moves, you build the case studies for your future trades. You stop trading on hope and start trading based on evidence. You have the confidence to hold for 5x moves because you've spent the last couple of weeks looking at previous examples of how that specific structure plays out. You're no longer surprised by the market. And this is what I've done. I've been a part of the market for so long that I've seen these setups play, and I can name you them without even having to look up the chart because I've seen them, I've been a part of them, and they're seared into my mind. I know exactly the setups I'm looking for, the similarities, and where it happened, when it happened, why it happened. Of course, this comes with experience, but you will build that experience through your own exposure in the market. Now, moving on to the next journey here, it is the profitable trader framework. So after going through the need for change and the required training, you will get to the profitable trader framework. And we move to solutions and strategy. So you need to have structured decision making. You don't decide what to do when the price is moving, you execute when the structure tells you to do. What it looks like is you use multivariable confirmation system. You look for confluence. Is social sentiment lining up? Does this currently have the required attention to run? Can it gain more? Do you see which playbook they're running from a technical structural context? Market conditions. Are you in a bullish market condition or are you in a temporarily bullish market conditions, which means this is a short-lived pump and we're going to have to take profits more aggressively because we don't know when this market's going to turn. So you have to be able to identify that. You need to have rule-based execution. Discretionary trading does not mean trading when you feel like it. It means having a rigid set of conditions that must be met before you allow it to take a trade. You establish hard filters. If the broader market conditions are red, you stay in stables. If a sub 5 million coin lacks active attention, social volume, whale activity, and a trending narrative, you simply ignore it. Currently, we are in a difficult market where liquidity is thin and you have to be extremely selective as to what coins you pick because not everything's going to move. And eventually, we're going to get a downturn, which is going to cause these coins to go lower. So you have to be selective and be aware where you are in the broader cycle because there are times to be risk on and times to be risk off, and it pays to be risk off at the right time so you can conserve that capital and put it to use at a better time. Capital preservation first. Capital is your oxygen. If you run out, the game is over. Most retail traders focus on the how much can I make. The professionals ask, how much can I lose and how can I prevent it? You have to prioritize defense, which means strict invalidations. You know exactly where you are wrong before you buy, or you risk accordingly so that if the coin ran to zero, you would be largely unaffected. That means you only risk what you're willing to lose. On-chain, there is no getting wiped out by liquidation. There is no stop hunts. You simply lose what you put in. So with on-chain, which is what we're focused on here, you have to only put in what you're willing to lose. You don't want to wait for God candles to exit. You take pieces off the table at predefined structural targets to ensure that even if the narrative rug pulls, you have already secured your initial seed. So I see a lot of people waiting to get to that round number of 50 million. Well, guess what? Thousands of traders are also waiting for that number. So you have to take off profits at different points in the charts to make sure that your risk is removed, at least your initial risk. Once your initial risk is removed, it takes off the emotional load and the pressure because you can no longer lose money you've invested. You can only lose the house money and profits you've made, which is a game changer. Sizing logic. You never risk more than the small fixed percentage of your total liquid net worth. You play the long game. It takes longer to get your portfolio bigger, but you stay safe and you still make money at the same time. Now, focusing on process over profits is extremely important at the start. Executing edge consistently. An edge is simply a higher probability of one thing happening than the other. On-chain, your edge is a combination of attention tracking, narrative selection, and structural entry. Consistency is the only way to realize that edge. If you skip trades that meet your criteria or take trades that don't, you are polluting your data. You need to be consistent in how you take these trades. You need to follow the framework because if you're feeling scared, but the criteria fits and you don't take the trade, you're simply wasting an opportunity there. So you have to be consistent. You treat every trade as just one of the next 100. You don't get high on a 5x win or depressed by a loss. You focus on repeatability. You show up every day to execute the same high probability setup, knowing that the law of large numbers will always favor the disciplined trader over the gambler. So variance exists within trading. You may have a 50% win rate, but your risk to reward is high, that it'll eventually put you in profit, but that requires time and enough trades for that result to show. Judging success by rule adherence. This is the ultimate mindset shift. A good trade is one where you follow your rule every time, even if you took a loss. A bad trade is one where you broke your rules, FOMO'd or entered on a saturated narrative, even if you made a 10x profit. Why? Because you can't repeat a lucky mistake, but you can scale a disciplined loss. Success isn't dictated by the result of the trade, it's dictated on whether you followed your framework. So you might have followed your framework, but you took a loss. That's okay. That's part of the game. It happens. Not every one of your framework decisions is going to result in a win, but over time, your wins stack up and you do get the result that you're seeking. Letting results compound. Compounding is the most powerful force in the market, but it requires time and stability. Most retail traders blow up their accounts before compounding can start. By focusing on the process and protecting your capital, you allow the math of growth to take over. You stop looking for life-changing gains in a single week. You realize that the consistent 100-200% gains on-chain repeated across several narratives will outperform a single 100x moonshot that you eventually round-trip back to zero. You play for the equity curve, understanding that as capital grows, your execution remains the same, but the dollar amounts become life-changing. So this happened to me. As I began to trade more and more, the wins I got started to outscale my cost of living, which allowed me to quit my job and travel around the world and do whatever I wanted. And this will happen as long as you're consistent with your execution and you follow the rules consistently. It does take time, but eventually you realize that you're simply following a formula and repeating this like you are a robot. Consistent strategy execution. As you can see, there's a theme here. It's consistency. Trading the same edge repeatedly. This is about identifying one specific setup with a statistical advantage and executing it over and over again without deviation. Your edge only reveals itself across hundreds of trades. Changing strategies midstream resets the clock and destroys the data you need to validate your approach. Think of it like a casino. They don't change the rules of blackjack when they lose a hand. They simply trust over time players will lose and they will win. And if a player is too good in the casino, they get kicked out. Not in the markets. Avoiding random decisions. This is the biggest killer of trading accounts. Impulse. Random decisions, chasing a move, revenge trading, entering without a trigger, these behaviors inject noise into your results. You can no longer tell if a loss came from a bad strategy or bad execution. Execution matters more than strategy, because if you have a strategy but you can't execute, then it doesn't matter. Discipline here means you only take trades that match your predefined criteria. No criteria equals no trade. You need to build a statistical confidence to understand the strategy and setup. You need to be able to trust it. This is what makes the other two sustainable. When you track your trades with consistency, you begin to accumulate real data, win rate, average risk to reward, expectancy. That data becomes your psychological anchor during drawdowns. You stop fearing a losing streak because you know what edge looks like over 200 trades. All right, and moving on to the last section here, patience and selectivity. You have to wait for high quality setups. On-chain markets are asymmetrical, meaning the best 20% of trades provide 80% of the returns. If you're consistently deploying capital into all right setups because you're bored, you won't have the ammunition, liquid capital, when a god tier setup finally shows up. What it looks like is you treat your capital like a scarce resource. You don't fire at every play. You wait for the specific alignment of attention, narrative, and structural support. And once that happens, you'll know it when you see it. When you don't see it, you won't have that feeling. And I'm not talking the feeling about, I want to trade. It's no, I found something because I've seen it before and I know what it looks like and I know what it feels like. So that's what we're looking for here. We're waiting for the play to come to us instead of us going looking for the play. Of course, you have to keep your pulse on the market, but for the most part, when it shows up, you'll know it's there. Doing nothing when the conditions are poor. There are times when the market is simply broken. When the macro environment is volatile or the on-chain narrative layer is exhausted, the probability of any trade working drops significantly. In these moments, the most profitable thing to do is nothing. What it looks like, you learn to value cash as a position. You don't feel the itch to be in the market because you understand that capital preservation is a form of growth. By doing nothing in poor conditions, you avoid the death by 1,000 cuts that liquidates retail traders during chop. So this is kind of the market conditions we're in right now. The liquidity and sentiment and risk appetite simply isn't there in crypto. So yes, there are plays going right now, but there's much, much fewer than there usually is. So you have to be extremely selective what you pick and be ruthless with profit taking. And finally, avoiding forced trades. Forced trades happen when your ego or boredom takes over the cockpit. It's the need to make something happen because you haven't had a win in a few days. These trades are almost taken with poor risk-to-reward ratios and no structural backup. What it looks like. If you find yourself looking for reasons to enter rather than letting the trade scream at you to enter, you walk away. You recognize that the market doesn't owe you a setup every day. By refusing to trade, you ensure that every dollar you deploy is backed by logic and not the desire to feel productive. So if you're staring at the charts 24/7, you will eventually be compelled to take a trade because you're doing nothing but staring at a screen waiting for paint to dry. The best thing to do is to monitor the market every day, have a routine. If the market shows no opportunity, you simply go about your day And if you're in a trade, let the trade breathe and do its thing. You're not meant to be monitoring it 24/7. Now, finally, we have the closing thoughts. The difference between an unprofitable trader and a profitable trader is rarely the setup. It's almost never intelligence. It's about the decision to stop trading like you're guessing and start trading like you are running a business with rules, with patience, and with a framework that protects you long enough for your edge to compound into something real. Every trader you admire went through this phase, where nothing felt like it was working. The ones who made it through are the ones who had a system and trusted it when it was the hardest thing to do. So to summarize the whole idea is you need to have an edge. Once you have an edge, you create a framework around that, and you let the framework do its job by getting out of your own way. Your patience is your weapon. Your impatience will sabotage you. Your need to trade will sabotage you. You simply have to find the good habits that make a profitable trader and eliminate the bad ones from what currently exists within you. This is a long process. And like I said, the key here is execution, because you can know all this stuff, but if you don't execute on it consistently, it means nothing. If I gave the strategies that I have to a trader and said, hey, use this, and they followed none of it, but they had the information, it would amount to nothing. So this is why it's so important to put execution above all else. So if this video reframed the way you look at markets, I put together a beginner PDF down in the description below. You guys can download that for free. And if you guys want to go deeper and build this specific framework around your situation, go ahead to my website, book a call, and apply to see if we're a good fit together. Hope you enjoyed the video. Make sure to leave a like, and I'll see you on the next one.